All right. So good morning, ladies and gentlemen. Once again, this is Reed Tattersall with Back Nine. Right next to me is Daniel Bennett. Daniel and I have worked together for maybe about 6 years now, and he's been an absolute pleasure to work with, one of the smartest guys I know in the business. And throughout my 11-year career, some of the agents that I've seen that have made the most amount of money in this business have dealt with pension cases. They are consistent. So they're consistently writing 10, 20, 30, $40,000 cases. The pension market, you don't have a lot of competition, especially if you are implementing some life insurance into the equation. And I thought this would be a good opportunity because a lot of agents out there have fantastic clients, and far too often we see a 10-year term or a 15-year term be implemented on a client who's making $200,000, $300,000, $400,000, $500,000, $1 million. So Daniel's going to share some strategies today so that you can turn that term insurance sale into a $30,000 commission. This is a great arrow in your quiver. And in addition, we're also announcing something new where if you submit to us a case on a high income earner and it looks like it can be a pension opportunity, we will be proactively reaching out to you, letting you know that this is an ideal pension opportunity, giving you some tools to learn more. And without further ado, I would like to introduce Daniel Bennett. Thanks so much for joining.
Good morning, everyone. Thanks for joining us today. Thank you, Reed, for the opportunity to share some of my knowledge with all of you about the pension whole life market. So today's presentation is going to be about pension whole life and how it can be a powerful planning strategy for business owners. So a little bit about myself. Again, my name is Daniel Bennett. I am a co-owner of Advanced Portfolio Strategies, and one of my specialties is actually the pension and business planning and investment arena. I've been in the business for 26 years, doing financial services, investment banking, investment management, and financial planning for clients. My marketplace is essentially the privately held business and the business owner, and working on various strategies that the business owner can use from a business level to advance his or her financial objectives. And one of the key areas that we work in is in the pension market. So without further ado, we'll go a little bit into the agenda. We're going to talk about sort of why one would want to enter the pension market, the value of working jointly with somebody. I'll share with you a little bit about my experiences there. We're going to talk a little bit about how the DB plan works and how it compares to, say, like the 401k plan, which everybody knows about. We're not going to go too into the weeds on that, but we're going to talk sort of big picture on how they work. I'm talking about an actual case study, and then give some tips on how to potentially identify a defined benefit plan opportunity. And then we'll go into Q&A. I don't anticipate this to be too long. I know everybody's busy, so we should be out of at least through the presentation part within a half an hour. So why enter the pension market as an agent or a financial services rep or as a financial advisor? So first of all, the benefits to your clients for you being in the pension market. First, it provides significant and immediate tax relief through the tax deductible contributions that are made to the pension plan. That's probably the most attractive part of it, and for most of my clients and the business clients, that's one of the key things that they're interested in, probably for obvious reasons. The other thing is that the pension creates a creditor-protected retirement income, which is separate from the business. This is another key selling point for the pensions, in that there's a statutory protection for pension plans that the business owner will immediately recognize as a benefit. It increases control. So when I say control, it's sort of financial control over their life. It reduces the reliance on the business value itself that the business owner is creating, so that they can retire when they want to and not because they have to. So it gives them this comfort that they have this pool of assets to generate an income, and doesn't make their exit out of the business totally dependent on the equity. In California, it's one of the few ways you can actually purchase life insurance on a tax-deductible basis, while preserving much of the tax-favored status of the death benefit. There's some nuances in there on portions of that are not tax-deductible. It's a very small amount. Not going to get into that right now. And then the death benefit, the death benefit feature of the pension plan provides for some protection for the spouse and the family. And also, and probably also very important for many of the business owners, is how they can use the pension plan to include key employees, encourage retention, and foster loyalty to the firm. Now, benefits to you as a professional. First of all, it enhances your value to the client and positions you as a trusted advisor. It's a really key part of being an advisor to a business owner, is really bringing to the table some knowledge that is very beneficial to them. Getting into the pension market will also increase your professional knowledge and your consulting skills as you work with business owners and try to help them, in particular, identify ways to reduce their tax liabilities. It gives you access to the highest value market in Southern California. A lot of people, many of you may know this, but Southern California is actually a mecca for the smaller privately held firms, both in the highly paid professional market, but also in manufacturing and distribution. So there's a lot of firms out there that are smaller, that are not, big national industrial type firms that you can work with in the pension market. And that's a key benefit to all of us. It enables you to interact with the client's advisory team. So you're going to also, through this process, build relationships with the CPAs, attorneys, and other professionals that advise the business owner, and you become part of that team. And perhaps maybe the big carrot on the stick here is that these pension cases can drive significant first-year commissions for your business practice, while at the same time positioning you as this, high value add advisor. So that's an important thing, and it was an important thing in my business and the kind of revenue that it drove when I first entered into this business 15 years ago. So a little bit about joint work. I don't want to press it too much. Anybody who's been in the business for a while knows that, when you're trying to develop a niche part of your business or a new part of your market, is really to work with somebody who has experience. So that's a really important part of professional development you learn through working with other people. Clients love the team approach as well, that it adds credibility and increases the customer service levels. We actually, from a joint work basis, working together, the pie gets bigger, generally speaking. Trying to do these cases where you don't have the professional experience it can become a lot more difficult and sometimes end in basically nothing. And then working with professionals that can identify opportunities that you might not have identified, or opportunities you might not be able to develop. That's also an important part of working in the business market, is there's a certain method that you have to use when working with them in order to develop a pension case. And ultimately, if you have production goals, I think most of the successful agents and advisors out there, they do. It helps you reach those production goals much quicker by adding these large cases into the mix. So let's talk a little bit about how a defined benefit plan works. And when I talk about defined benefit plan, there's a variety of defined benefit plans. There's cash balance plans, money purchase plans, traditional defined benefit. I'm just sort of lumping these together without going into the nuances of each of these plans. They're There are pros and cons of all of them. So we're just talking about defined benefit plan itself. So in the universe of pension plans, there's two types, broad types: defined contribution plans and defined benefit plans. Most of us are very familiar with the defined contribution. It's 401k plans, profit sharing, SEP, simples, and by definition, contributions are defined or they're limited. And the IRS sets that limits every year or every few years on what you can actually contribute into those plans. When money goes into the plan, the investment risk falls on to the plan participant, generally speaking. There's a couple of exceptions, but generally it's the participant that takes the investment risk. And really the asset allocation is based upon, or most of the time, the individual needs. On the other side, there's these defined benefit plans. So like I said, there's traditional defined benefit, cash balance, money purchase, and other types of plans. Contributions to these plans are generally speaking driven by a benefit formula. I'm not going to go into the nuances of that, but there's a formula that is defined by years of service, pay, et cetera, that provide a benefit when you retire in the future. And now IRS defines the eligible pay. There are certain definitions that they put into place, but generally speaking, what you can put in is based upon a formula. The investment risk of the plan falls on the plan sponsor, essentially. So the company sponsoring the plan is generally responsible for the investment risk and making sure that the plan is funded. And then asset allocation is generally based upon plan liabilities, which we call liability investing. And those are the key differences between the two. How do we set one of these pension plans up? Well, generally speaking, the company who's sponsoring a plan creates a pension trust through an adoption agreement. They adopt a plan, and the company is deemed to be the plan sponsor. And then there's a summary plan document that describes the provisions to the participants, how the plan works. There's also a plan document itself, which contains all the plan provisions. Basically, it's the guidelines of how the plan actually works. The summary plan document itself is the document used to describe it to the various participants. Now, to compare and contrast, when we look at defined contribution plan, we'll look at the 401k plan because that's probably the most ubiquitous type of plan out there. When you look at the employee making a contribution to the plan, whether that employee is the employer or not, it could be the employer, the owner themselves, or employee. They can make a salary deferral from their salary, whatever pay that they're getting. Every year, the max you can contribute goes up. I think it's at the time I did this presentation, it was 19,000. It's potentially going up, and then there's a company match. And most of the time, what you see out in the marketplace is 4% of pay. Though it doesn't have to be 4%, but 4% is the safe harbor rate. So that's what you typically see out there. And so the employee's salary deferral goes in there along with the company match, and it goes into the profit sharing plan trust account. And usually those are in most 401k plans, it's what they call self-directed. So there's a sub account essentially for each of the participants to make their own investment decisions, et cetera. So when we look at this, and this is a simplified example, but I use it to illustrate a point. So say you had an employee earning 50,000 and they were age 30 and they were going to do the full 19,000 deferral. That's probably not realistic, but for the sake of argument, let's say they make that full deferral and then they get it 4% of pay, which on the matching, so it's an extra 2,000. So the total contribution going into this plan is 21,000 for that employee, most of it being their own salary. So that represents, we're looking at it as a percentage of what they're putting away, what they're able to put away compared to their pay, is 42% of pay. Now the owner who makes 250,000, age 55, they do a 24,000 with catch up, and they do an extra 4% of pay. So they're able to get 34,000 in based upon 250,000 of pay. That represents 13.6% of pay. the illustration here is really, so 401ks seem to be the plan of choice, but they're really much more highly leveraged or potentially leveraged towards employees. The owner, even though they make a lot, is highly restricted, and that's because of those limitations, contribution limits on the 401k, particularly on the deferral side. So when we look at the advantage of defined benefit plans, there's a few things that they look at. 401k is basically based upon pay and what you could put away, and of course what the company will match. There's a little bit of age benefit too. If you're older than 50, you could put a little bit more money away. But the defined benefit plan looks on pay, age, in terms, and the age here is really in terms of the number of years you are from retirement. So the shorter that is, the bigger those contributions can be. And also potentially years of service. We can look at years of service to help increase the contribution to the plan. So when we look at the contribution result for a defined benefit plan, the same scenarios we looked at for the 401k plan, if we're looking at the employee again, $50,000 of pay, age 33 years of work, and the replacement pay earned is around 6%, estimated contribution about $3,500. So that's around 7% of pay. Now look at the owner side, it's $250,000 again. Look at 20 years of work. We look at pay replacement earned 40%. The estimated contribution is around $200,000. So that's represents about 80% of pay that the owner can put in relative to pay. Now, maybe looking at percentage of pay is not the right way to look at how these contributions stack up. I look at it that way because essentially, that's the rate of deferral, the rate amount you can put in. So you can see here that the leverage for the owner in defined benefit plan is significantly higher. Ultimately, what we're trying to do with the defined benefit plan is generate a certain amount of assets inside the plan that's going to replace a certain amount of pay in retirement. And so age clearly has a huge factor in this. And it's one of the key things that we look at when we're looking at plan design is what's the age of the owner, what's the average age of the employees, et cetera, if there are any employees. So from the owner's perspective, say they're paying a 45% tax rate. So on the 401k side, they're able to they put 34 for themselves. They make a 2,000 contribution to the employee. And then, so the total contribution from the owner's perspective is 37,000. So there's a tax savings there of 16,650. Most of it's still going to the owner because that owner's looking at, hey, I was able to put 34,000 away. It's not bad. But when you look on the defined benefit side, you have $200,000 contribution to self, a $3,500 contribution to the employee for a total of $203,500, and the tax savings now is $91,575. So that's the actual tax saved that would otherwise been written to the government in the form of a federal tax payment, federal or state, depending on what their rate is. But so that's a significantly higher savings. And this is really where the attraction of the plan comes in. Now, I know this is a pension whole life conversation. We're getting there, but this is important to understand this part of it because the way the pension sales work is you're leading with the tax angle, right? That's a very important aspect of selling the plans. Here's the team that's going to be involved. Financial advisor, you, me. There's always going to be a CPA involved, and a third-party administrator is going to be involved, and of course the client. We had mentioned earlier that it's a great way to develop relationships with CPAs. CPAs in our business tend to be a good referral source. It's a great way to develop relationships with CPAs. As you meet business owners, it's a way to connect with the CPA as you work on these pension opportunities. So I'm going to talk a little bit about just one case study, a recent one that I did. I could give you a ton of them because I have a lot of pension plans that I work with, but for the sake of time, I just show one. So this case, the facts about the case, it's a successful family law attorney, somebody I met through networking. She operates as an LLP, age 55, and has a successor owner daughter, age 30, involved in the business as a young attorney. They have a 401k and they have their business expenses. They've done the CPA has done a great job in working all the angles on getting tax deductions and maxing out the 401k. So basically, pretty much exhausted. Company's doing really well. We're talking an attorney that's making excess of $1.5 million a year in revenue. So the net taxable excess income after she pays herself is $250,000. There's one key employee, a legal assistant that's been with her for a long time, very key person to the operations. She wants to retire at 65, and ultimately the daughter wants to take over the practice. And the company is growing, and it's a niche high-end market, wealthy, high-end net worth market. So obviously she's interested in tax relief, and so is the CPA. CPA is very interested in tax relief. In fact, in this case particular, had an interesting angle. The CPA was the one actually telling the client to get a pension plan. She just had never met anybody who knew how to do it. Maybe I was the lucky one. I was there at the right time. We talked about it. In fact, I really met this case through, I was referring somebody to her. One of my clients was getting divorced. And we talked about it, and she goes, "Oh, my CPA said I need to get a pension plan." So that was maybe a little bit more of a layup than usual, but it was a great opportunity. Like I said, 401k was maxed out, and really the owner was underfunded for retirement savings, making a lot of money but high expenses, living in a high net worth environment. So really need to get behind that in the next 10 years. And then the key employee, like I said, had many years with the firm, and the owner wanted to be able to secure that person to the firm, sort of give him some golden handcuffs, and so she would stick with her. The solution was the defined benefit plan. So that added an extra $150,000 deduction as a pension contribution. We structured the plan to put to make the contribution in favor of the owner, but at the same time gave a nice defined benefit contribution to the key employee, and she also gave a generous match on the 401k side and profit sharing side to stay. So it was really good for the key employee. By the way, the daughter and there's another son that worked for the business were excluded. So we didn't have to put them in as highly compensated employees. So the plan really worked out. The plan design worked out really nicely. This is the actuarial spreadsheet that was done by the actuary for this case. So you can see here, there's several columns from like that. There's a name, age, the plan, that's the compensation, they're highly compensated or not. Defined benefit allocation, profit sharing, and then total contribution that goes on, and then there's the deferral, and it shows at the far right the total with the 401k. But the key thing here on the defined benefit side is that contribution to the defined benefit and how it's allocated. So their 90,000 was targeted for the owner, and 3,600 was targeted for the key employee. So when I do these pension plans, what I'm primarily trying to get the owner to understand is the structure of the plan and how it works, how that contribution works, how that contribution is a benefit to the owner. That's first and foremost. You notice so far, I'm not really talking too much about the pension whole life. But one of the key things that we can do, once we've established that this is a great opportunity for tax savings, then we start talking about the structure of the investments. And one of the things more towards the end of the sales cycle is to talk about how we can make this plan insured or not. meaning we can add a pre-retirement death benefit provision to the plan that's going to protect your spouse or your children and make sure that this pension plan is self-completing. We can do it or not do it, but if we do it, generally how we fund it is we use a pension whole life, which in the long run sort of acts like the bond portfolio inside the pension plan or part of the bond portfolio. And that's usually how the pension is closed, how the pension whole life is closed, because, and what we're targeting is really only about 30 to 40% of that contribution is going into pension whole life. But as you can see in this case, it was about $40,000 between the two of them, just shy of it. So $40,000 of premium was going into the pension whole life. There's different professionals that have different opinions on how you structure that pension whole life, but I tend to make it a cash value performer. So in this case, it was a 10-year plan we're essentially looking at. So I did a 10-year pay on this. So I can get in, if anybody has any questions later on how that works. I'm not going to go into the real details of how these pension whole life policies are structured, but we can do that maybe offline if you're interested. But the point here is there's a big pension whole life sale structured into this, which is by the time you're getting to this point and you're looking at this design, this plan design for the owner, the conversation is no longer, it doesn't feel like a life insurance sale. What it feels like is a pension plan that's going to provide for income in retirement and provides a pre-retirement death benefit to protect their family. And since they're getting the deduction, they're all in. They're typically all in. There's usually not a problem with it unless there's a underwriting problem, and maybe if it's a shorter term, there might be an issue. But most of the time, it's the life insurance part is it just becomes a part of the whole process. And that's basically how I go about doing the pension whole life sales for my defined benefit plans. In this particular case, I think the FYC, I went to do the quick calculation. I think it was about 32,500. Most of that being the pension whole life, some of that being the investments. We also manage the investments for these pension plans, so part of our compensation was in the investments. But as you can see, it was a really significant case, and it was a powerful case because it did amazing things for the owner. I looked like a rock star with the CPA, and it was a great revenue generator. So ultimately that's what this pension whole life business and the pension planning business is all about. Some things, if you're not familiar in the business market, some of the things I would suggest as far as to what to listen and look for is obviously when a business owner or some professional is complaining about taxes, right? That's a key signal. You should be talking about pensions when there's that complaint about the taxes and how much they're paying. Also, if they're sometimes they'll joke about, oh, I'm going to work forever and I'm not going to be able to retire. That's another time to be maybe bringing up conversations about what a pension plan can do for them. Certainly in your universe, you want to be looking for CPAs that have a pretty good client base of business owners or self-employed professionals. The CPAs are really good referral sources, and they really understand this very well. Obviously, you want to look for profitable business owners. There's a lot of people, if they're not making money, they're not going to be a target. And then the age range is probably pretty important here, 45 to 65. Not that you can't do it below 45, but just the numbers look better when the owner tends to be a bit older. And always just keep your antenna up for the opportunities when you're out there talking, and maybe bringing it up or dropping a suggestion and trying to get the conversation started. So I'm closing this out as a brief presentation. If anybody has any questions, please let us know now. Reed's taking a look at these. That is that a question?
That is not a question. And the questions
Would be on the chat. No,
it's not on the chat. I always have trouble with
if anybody
this.
has a question now, please you can send us a chat maybe.
They can't send us a chat.
Oh, you can't send a chat. Okay.
No. Here we go.
Oh, how do I contact you? I'll have Reed send you my contact information.
Yeah, we'll send a copy of the slides in this presentation to everyone, and you can get in direct contact with Daniel.
Are there any other questions? I'm going to anticipate one question about the QBI.
Go ahead.
It's Daniel Bennett.
Daniel Gates is another guy that works here, and Daniel can also introduce them to you.
Yeah. Yes. Okay. Yeah, it's Daniel Bennett. So the qualified business income deduction. Here's another quick tip for you. If you're out there in the sort of like not the mid-sized company where it's a pass-through company that may be losing their QBI based upon their income. QBI is a qualified business income deduction, roughly 20%. I'm not going to go into the weeds on this, but the Tax Act, the last Tax Act passed, created this deduction, but it's phased out for couples that make more from 315,000 of household taxable income to 415,000. So if the income's above 415,000, you lose that qualified business income deduction. And a pension plan, being a line item on the business P&L, can be put into place to reduce that income, that business income, and potentially recover that qualified business income deduction. So anybody out there that has a little bit more sophisticated knowledge of how these counting aspects work, it's a great sale. It's going to be a great sale this year because people are just starting to understand how this works. And people who are going to get phased out, they're going to be really upset. And those people that are getting phased out actually make enough money to make a pension contribution. So we should all be looking at that. Any other questions?
I see some hands raised. I think it's going to be easiest if we just use the chat or the questions within GoToWebinar. So any other questions, if you could just go ahead and type them in.
So the question came, is it true that pension plans will be required by employers beginning next year? So it's not pension plans per se. It's California law requiring, there's a new California, essentially it's not a 401k, it is a 401k, but there's no company requirement to match or anything like that. It's basically a salary deferral system that California is instituting for certain businesses that do not provide a plan for retirement. It's really bare bones, and it really doesn't address any of the kind of retirement planning problems, but there is that, but it's not, there's no requirement on the part of the company to make a contribution. So yes, there is, but it's not a pension plan. Okay, will this work if the only other employee is a W-2 employee and also spouse of the company owner? Yes, it will. In fact, that's a really good situation because, well, if they don't have any other employees, they can include the spouse or not include the spouse. So depending on the size of contribution that they're looking for, will depend on what if the bigger contribution, you could include the spouse and increase the contribution or not. Yes, it will work. You can just, in that case, you can just pick one, the owner, and the spouse can be excluded. So if that makes sense.
All right, I think that's it for questions. Daniel, thank you so much. Oh, we got one more.
Let's see.
Two more.
How and when must include non-key employees on the PSP and DB plans where you're putting life insurance. Okay, so I don't do too much in profit sharing plans. I don't put pension whole life in profit sharing plans, generally speaking, but on the DB side, non-key employees get insured for this basically the same on the same level of insurance, which is relative to income, as the owners. And that, you know, it really, depending obviously on the age and the non-key employee or the non-highly compensated employee, depending on the age, will kind of dictate how much that is. So, but generally speaking, it's not an issue. But yes, you do have to cover them. At least you have to try to cover them. If you know, I guess there's always potentially underwriting issues and things like that, but you have to try to cover them. So you have to make a good faith effort to do that. If the business owner is not in good health, can he still qualify if he has a certain number of employees? So the connection between the underwriting and the number of employees, there's not really a connection between the two. I think what in that instance, if there were serious health issues, we'd probably do a informal inquiry first to determine whether that person is insurable, because that's partly going to dictate what the owner wants to do when you're talking about the plan design. In other words, to put the pre-retirement death benefit in there. But if they can't, we would certainly try to get them qualified. And by the way, if they have health issues, that's more of a reason to get the life insurance. So yes, we're going to do our whatever we can to get them insured.
Yeah, and several of the good whole life companies, they have guarantee issues starting at 10 or more.
Yeah.
So this would be a rather large pension plan case.
Yeah.
So 10 is that magic number. That's 10 white collar individuals,
yeah.
not, you know, rank and file.
Yeah.
So it's certainly not common, but yeah, if you came across a big opportunity on an uninsurable business owner and there were 10 executives, let's say it's a law firm or talent agency or something like that with lots of highly compensated, it can be done.
So any insights, exit plan for the insurance policy later. So there's a couple of questions coming in here. So good faith just means, you know, you're doing the application on the participant. The reason why I said good faith is there's always a potential that the participant would refuse to be insured, and that would have to be dealt with. You can't force someone to go through underwriting, but you have to offer them the insurance. It has to be you know, an equal opportunity to have the insurance. On the exit side, that's maybe a longer discussion, but it's a very good question. And you know, if you've been involved in those before, you know that that's an issue. The reason why I like to use shorter term is because I want to use insurance as a performing asset. Unlike there are people out there that will do, you know, a life pay premium, which is smaller, which takes years and years and years, maybe 15, 20 years to break even. And I don't like that for that reason. So I want them to be able to exit it, either purchase out the insurance and or if they're going to terminate the plan and terminate the insurance, that insurance was a performing asset. So I know there are different theories about that, but that's my preference. But exiting the insurance outside of the plan is always an issue, but I don't think it's an insurmountable one. Let's see. Oh, you're on a different one. Okay, is there any other, when is the debut? What was that? Did we miss one there? Also insights. Okay.
I think we got him.
All right.
All right, everyone. Thanks again. Look out for an email with the recording, and I'll include Daniel's contact information as well. Have a great day.
Thank you.